Trader expectations of rate cuts in September are rising here, and they're now over 45% for this morning as of right now. This coming after the PCE data largely coming in line with expectations. Here to break it all down and what this print means for the broader market, we want to bring in Kristina Hooper, Invesco Chief Global Market Strategist. Kristina, it's great to have you here. So talk to me just about how you're looking at this PCE print and what you think that tells us about the Fed acting. You're saying it might even come way before September in July.
Absolutely. So I have to look at it as part of a mosaic, right? Mm-hmm. And I have to look at the data before it and, of course, anything that comes after it. But what it is telling me is that there is a disinflationary trend that is well in place. Yes, there was a stalling of it in the first quarter, but that arguably was at least partially seasonal. Mm-hmm. And what we've seen is a reacceleration of disinflation in the second quarter. It's not just the PCE print. Of course, earlier this week, we got the second estimate of first quarter GDP. That showed a cooling economy, and it also showed cooling inflation. And so, and of course, we also got Michigan inflation expectations that came in below forecasts. So all of that tells me that the Fed is in a better position today to start cutting, to feel comfortable about starting to cut. Now, I think June is definitely too soon. I think they'd want to see another month of data that supports that disinflationary trend because, again, that first quarter stalling spooked them. But I think it is very, very possible that we get a July cut, if not July, September.
What would core PCE inflation need to fall to? We had one of our esteemed guests from HSBC saying to us that it may need to fall to around 2.5% for the year-over-year number.
So I think that it doesn't have to hit that for the Fed to be comfortable as long as the Fed sees that the economy is cooling. So that tells them there's probably less of a chance of any kind of resurgence in inflation. But just seeing that movement, that easing, I think should be enough. Because keep in mind that we're now at the point where the Fed has some very significant risks that it is creating the longer it keeps rates at these very high levels, because there are long and variable lags to monetary policy. I'd argue we haven't seen all the damage to the economy yet because of those lagged effects. So it has to worry about that. It has to be thinking about where the puck is going as opposed to where it is today.
Inflation and the Fed, is that ultimately the biggest driver of the markets here in the short term?
I think so, absolutely. But there is that consideration that we are seeing a slowing in the economy, and we are seeing a two-speed economy, right? We're seeing lower income Americans under more pressure. And it's not just pressure from inflation. That's actually starting to ease, as we're seeing. But it's also just pressure in general. We're seeing credit card delinquencies go up. Now, nothing alarming, but again, we can assume that that is going to move higher as time goes on, especially if rates are kept at these levels.
This is just one of the factors, of course, that investors consider, that voters consider as well in inflation. And for that, they may equate that back to, okay, this inflation feels like it's happening under Biden. So that's a tick in one department. Then you look at the overall campaigning and the general election, and now you've got the latest headlines out about the conviction for former President Donald Trump as well. Where do voters balance what's taking place with inflation versus all of the other kind of surrounding circus-like events that are taking place?
And that's the $64,000 question. And I am absolutely no political expert. I try to stick in my lane, which is markets. But what we've learned over time is that typically, and I don't remember who coined this phrase, but it's the economy stupid. So at the end of the day, it's going to be about where the economy is when people go to the voting booth.
What about volatility? Sorry, real quick. Is it going to add to volatility at all, you think, in the short term? Or how do investors typically view? We haven't had something like this exactly happen before, but the lead-ups here to election, does it typically look a bit more volatile?
I don't think so. Historically, we just haven't seen much of an impact. And especially today, what's driving markets is the Fed, or I should say expectations around what the Fed's going to do. I mean, if we look at movements on a day-to-day basis, most of those movements are being driven by data points or Fed speak that drive investors to assume one thing or another about what the Fed's going to do.
Kristina Hooper, Invesco Chief Global Market Strategist. Kristina, great to see you. Thanks for joining us in studio.
Great to see you. Thank you.